June promises to be another huge month in financial markets, and here are 5 events that I think traders are going to be paying very close attention to over the course of the coming month. The jobs report is always a huge event for the markets, but with the economy showing so much resilience and inflation so much stubbornness, that is especially true for the labour market report this month. Now, there's different components of the jobs report that we need to keep a close eye on for different reasons. The unemployment rate is expected to tick higher, but we need to see more slack in the labour market than that over the coming months if the Fed is going to be comfortable to end the tightening cycle. Then it's the wage growth number. Now, wages are expected to subside a little bit, but again, we need to see that on a sustainable basis in order to be consistent with inflation returning to 2%. And we need to see a couple more reports again of inflation subsiding and therefore wage growth subsiding if the Fed is going to be confident in its outlook and the assessment for the economy, but also, most importantly, for inflation. And finally, it's the jobs growth number. Labour market tightness has been a massive problem for the Federal Reserve, and job creation has remained very strong throughout this process. The markets are expecting a little under 200,000 jobs to be created over the course of the last month, but in reality, we may need to see something much lower than that, again, if the Fed is going to feel confident enough to end the tightening cycle at its meeting this month. Inflation has been a huge problem for the global economy over the course of the last couple of years, initially with the acceleration on the way up to the top, and now with the stubbornness on the way back to 2%. Central banks still have a lot to do in order to achieve that 2% goal, and inflation data over the course of this month is going to be watched very closely as a result. The 2 standout inflation releases are that from the US and the UK for different reasons. The Federal Reserve's interest rate cycle has massive influences for the global markets, but for other central banks as well. And therefore, we're looking to that CPI release for signs that we are seeing inflation abating further in order for the Federal Reserve to allow itself to end the tightening cycle. The UK is slightly different. It's not got as much of a global influence, but with inflation remaining so stubbornly high, and we saw that from the release last month, with inflation remaining at 8.7% and core inflation actually rising another 0.6 percentage points, the Bank of England may have to go much further in order to achieve its inflation goals. And if inflation again disappoints to the upside or remains more stubborn than the markets are expecting, then I expect we'll see more interest rate hikes being priced in from the Bank of England and the terminal rate remaining there for longer than the markets currently anticipate. At the last Fed meeting, the central bank opened the door to pausing the tightening cycle going forward because it believed that it was making sufficient progress towards its goal of price stability at 2%. But a lot has changed in that time. We've seen a lot more stubbornness in the inflation data. We've seen a lot more resilience in the economy, and therefore the odds of another rate hike at the next meeting have increased substantially since that last meeting. In fact, markets are now pricing in a slightly higher chance of an interest rate hike at the next meeting rather than a pause. Now, there's a number of pieces of data which we'll get in the interim before the Fed next meets, which will have a massive role to play in determining whether the Fed will hike again or pause, but a lot of focus is going to be on that decision because we're now hitting a period, because interest rates are above 5%, where every interest rate hike is seen as a risk to the US economy, but also to the global economy as well, and also, as a result, the health of the financial markets. And therefore, we can't understate how important the next few weeks is in determining where the Fed is going, how long it will ultimately stay there, whether interest rate cuts this year are a realistic possibility or more of a fantasy as far as markets are concerned, and therefore what the economy therefore looks like for the rest of this year and going into 2024. The European Central Bank has flown a little under the radar over the course of the last few months because it's not being viewed to be near the end of its tightening cycle, and therefore there hasn't been quite the focus on it as there has on other central banks. Yet the central bank itself is expected to keep raising rates this month. Another 25 basis points is priced in, at which point we may be getting towards the end of the tightening cycle, or at least that's what markets currently believe. The economic data, on the other hand, may be pointing as well to more resilience as we're seeing elsewhere. inflation has fallen heavily from its peak above 10%. It's now around 7%, but core inflation has not. In fact, it's very close to its peak at just over 5.5%. And that is going to be a massive concern to European Central Bank policymakers. And I wouldn't be surprised if at this meeting we do see them nod towards that inflation data and remain committed to its hawkish message rather than signaling a pause in its tightening cycle. And that's what investors are going to be looking for. They're going to be looking for signs that the European Central Bank is not quite as positive and optimistic as markets are currently, and that they may nod towards more interest rate hikes to come. There's a long way to go before economies get inflation back towards 2%. And until we start to see clear signs of progress, particularly on core inflation, then central banks may maintain that hawkish message, and we may see market expectations adjust continually during that process. Bank of England interest rate expectations have changed considerably over the course of the last couple of weeks, ever since we got that inflation data which showed inflation falling from above 10% to 8.7%, but that was a far cry from the 8.2% that the markets were expecting. And what's more, core inflation actually rose by another 0.6 percentage points, which means the Bank of England likely still has a big job on its hands getting inflation back to its 2% target over the medium term, despite its confidence that it will do so at the various meetings which we've seen over the course of the last few months. That inflation data did spook markets. Interest rate expectations rose by almost 0.75 percentage points over the course of the remainder of this year, which means markets are now pricing in another full percentage point of interest rate hikes, bringing the terminal rate to 5.5%. And the next interest rate decision in June will be core to that. 25 basis points is currently priced in, but if Bank of England policymakers are similarly spooked, then that could potentially change over the course of the time going into that meeting, and we may see a slight change in tone from those policymakers around the interest rate outlook on the back of some of that worrying inflation data that we've seen from the UK. For more views and analysis from myself and the rest of the team, check out MarketPulse.com. Also, don't forget to subscribe to our YouTube channel and the Market Insights podcast.